welcome to SFI Not So Live with me, Jay Evans, your host. Welcome. It's August. How have we got here already? Who knows? But not enjoying the best of weather. If you can remember back to when we were recording on the 28th of July, it's a bit miserable, it's a bit wet, it's a bit cold. But we're here to brighten and cheer up your day. And I'm joined by a stand-up panel to help me do that too. So without further ado, I think we'll go around the room. Before we meet our special guests, let's look at our regular panelists. So first of all, Phil. Phil, welcome. Good morning.
Hi everyone, I'm Phil Lawford. I'm the National Account Manager at Saffron for Intermediaries. I've been in the industry for over 30 years and my job at Saffron is to look after our intermediary relationships, our key partners, and ensure they get the service that they deserve.
Thank you, Phil. And over to Phil's colleague. He hasn't been with us for a little while, Simon. Simon, welcome. Simon, a quick introduction for you, please.
Thanks, Jay. Yeah, it's been a while since they let me on the podcast. I've obviously behaved recently. So I'm Simon O'Donnell. I'm the field-based BDM for Saffron, covering London and the South East. So my role is really the day-to-day sort of relationship managing with our brokers, taking their queries, answering them, going out to see them, that sort of thing.
And last but very much not least, we like to throw curveballs on this podcast, and this time we've gone for a different section of the chain, and we've got ourselves a legal expert. So I'm not going to do the introduction, I'm going to let her do it. But Perdip, welcome to SFI Not So Live. A little introduction, please.
Thank you, Jay. Hello, everybody. My name's Perdip Gorbachew. I am a Senior Associate Solicitor at Black Solicitors, and I specialise in buy-to-let transactions, acting for a wide range of clients, be it individuals to private landlord investors, and a wide range of lenders, be it high street lenders and the specialist lenders. So I am very, very happy to be here today.
We're really pleased you could join us. So buy-to-let is one of our favourite subjects. We're looking forward to talking to you about that, and we're going to get your opinions on some of the stories that are coming up too. Thank you, Perdip. So without further ado then, shall we just crack on? A little caveat from us though. We are a mortgage and property podcast. We talk about the property market, mortgage industry, what's going on, any sort of breaking and relevant news that's happened this month or within the last week normally. And we're here to give our own opinions, so not necessarily that of our employers. So I'm going to stop waffling and it's time to move on. So let's go on to our first story. And it's submitted by Phil. So, Phil, I'm going to come to you first. Let me just do a quick introduction to what it is. So, IMLA and Amy, two industry bodies, have come together to create this report document that is put together to kind of assist brokers and other people in the industry to kind of understand the complexities of lending. And I know one of the big issues we've had ever since the pandemic was this removal of products in with no notice and how frustrating that is. And this does address that. So, Phil, I'm not going to waffle on. I'm not the expert. I have read it. It's a brilliant report, but I would really like your opinion. So let's do it. Let's, Phil, give us your analysis of what you've read.
Yeah. So it's quite amazing how fast the market and stories move because of when we talked about this a few weeks ago. The intermediary market was very turbulent. So lenders were withdrawing rates quite quickly. We seem to have had at that time an upward curve in rates, so they seem to be going upwards. And for intermediaries, for brokers who are trying to place cases with lenders, the stress is just immense. They're absolutely shattered. I know brokers were working very, very long hours trying to get the best rates possible for their clients. On occasions, rates are available at 9 o'clock in the morning, and by lunchtime, that particular rate, they were keen in a case, that rate had disappeared. And it causes immense frustration for brokers and their clients, their customers as well. And understandably, it caused some anger and frustration. And what Amy, who are the trade body for brokers, and IMLA are effectively the trade body for mortgage lenders, the two trade bodies had come together with the aim of producing a guide aimed more at brokers to help them understand how lenders' funding models worked and I suppose really the idea of it is to see how we, as an industry, can come together and work together through difficult times like this. So I suppose setting the scene for the last, I don't know, 12 years or so, we've been in a very benign rate environment with low interest rates, not a lot of movement. So for a lot of brokers relatively new to the industry, as in new as in the last 10 years, they've not seen this before in terms of rates moving. I'm old enough to remember what it used to be like, in the 90s and the noughties when rates were more volatile. But there's a variety of ways lenders are funded, and that will affect or can affect how lenders can give notice, and there's other factors in play. So what this guide to understanding lender funding does is tries to summarise all the factors in play, and explain how it works, just so everybody can understand where lenders are coming from. So effectively, I suppose trying to summarise it, you've got balance sheet lenders and non-balance sheet lenders. So balance sheet lenders tend to be banks and building societies who are funded by their retail funds, so their savers or their investors. And then you've got non-balance sheet lenders who have to fund their lending through other means. Now, one of the big funding models for non-balance sheet lenders is something called securitization. So they have a funding line which they then sell on to investors who effectively buy bonds and should get a return on that investment. That's sort of very basically how it works. And then balance sheet lenders, there's different models because of you've got, I know, banks where there's shareholders and they might pay dividends to shareholder investors, so there's a return on investment factor there. And building societies, a mutuality model where effectively mutuals are owned by their members. So there's a lot of factors in play, and then the other big bit is fixed rate lending. Most of our lending is done now on a fixed rate basis. There is variable rate lending out there, and that's become more common with some of the turbulence in the market, because sometimes variable rate lending, although it goes up and down, it can be priced lower than fixed rates because you're paying a premium for the certainty of having a fixed rate. So now when lenders lend on fixed rates, they have to effectively hedge or swap those rates. So they have to buy the funding on money markets. So that's an additional factor in play as well. So all of these have come together in this perfect storm, which means that lenders have to move pretty quickly when the market moves at a pace like it has done. So we've seen the swap rates, which is the rates that lenders are buying their fixed rate funding at. They've been moving very quickly because it's market related. So part of that's to do with confidence. So if lenders don't move quickly, they effectively financially they could be underwater. So a large lender might be in a situation where they've got a margin on their rates at 9 o'clock in the morning, but by lunchtime they could be making a loss. So they have to act quickly. Saffron, we're in a position where we are retail funded by our savers, but we do have to hedge because of a lot of our funding is variable rate, not fixed. So hence we are also reliant on the swap rate market. So those are the factors in play. I've probably waffled a bit, but I was trying to get the key points over. Now, as a lender at Saffron, we have always, and we've managed to give 24 hours notice, and we pride ourselves on that. But I do understand the position of some other lenders who may not be able to have that luxury of that. And that's what's caused a lot of the angst and debate in the market. I would always like to think that we could give 24 hours notice to withdraw, but I can't guarantee it. And as much as I would like to sign up to every charter saying, yes, we will commit to giving 24 hours notice, the reality is we can't, because of there might be a scenario when we might have to pull with shorter notice. But we are dedicated and committed to giving that notice and being as fair as possible with our broker partners. And I don't think other lenders who are giving less notice want to be in that position. That they're just it's just where they are, and there's been some very, quite angry positions from some brokers, and I can understand their position. And then there's been some more balanced and nuanced positions from other brokers and the trade bodies. So I think it's good that the trade bodies have come together to put this out, just to try and make it more, make it easy to understand the challenges that the lenders are under. And I think the main message is we all need to work together as an industry. So, we can get through it. Hopefully now, 2 weeks on from when this was originally sort of published, things have calmed down a little as well, which might make everybody's life a bit easier. But we'll see, because I know some of the topics we'll talk about later will cover some of that. So I'm conscious I've talked a lot about this. I'll hand the floor over to everybody else for their views.
Simon, what's your thoughts on this?
Yeah. So similar to what Phil said, we've always tried to give 24 hours notice where we can, and historically we've done that. Certainly over the last few years that I've been within the team, but where we can, we will, because it's the right thing to do. But as Phil says, we can't. Not in a position to guarantee it, unfortunately. But it's a real difficult balancing act, I think. So last year we were sort of shortly after the mini budget, we were inundated with applications coming in really strong, and the noise in the market, quite rightly so, was lenders are pulling last minute with an hour, 2 hours, whatever it may be. And I think we tried to do the right thing, and we gave 48 hours notice. Phil, you'll remember this, and actually that was probably, in hindsight, it shot us in the foot a little bit, because the applications continued to come in, and ultimately our service levels went to not an ideal level. Yeah, they went through the roof. Yeah, and it was a tough time. I think we've learnt from that, and we've given 24 hours notice. But what we have been really good at recently, I think, as well, we've been transparent as well. So we've been at the outset, if our SLAs are increasing, or we're pulling products, we're saying, look, we're giving you 24 hours notice here, because that's we think that's the fair thing to do, and we're in a position to do so. However, our service levels are probably going to increase with that. So it's up to you as a broker to, you've got the opportunity to make an informed decision as to whether or not you want to pursue, knowing that perhaps the rate might be a little bit cheaper, but you're probably going to have to wait a little bit longer for it. Alternatively, if it's time critical, you've got the opportunity to go elsewhere, and you've got that, you've been able to make that informed decision. But I really, really do feel for brokers, though. I still remember last year in sort of September, October time, possibly August as well, actually, the amount of brokers I spoke to that were literally on the beach by the swimming pool. They were on holiday with their family, and they were having to ring me to try and get cases through, to get updates. Does this fit? The rates have moved on so quickly. They were spending a lot of time on their family holiday, ringing lenders and BDMs, trying to get stuff through. So I absolutely feel the pain of brokers. I really do. But like I say, Phil says we'll try and give that 24 hours notice where we can.
So, Paddy, we're going to come over to you then. Thanks, Simon. Can I come over to you then? What's your thoughts on this? I mean, it's kind of, it surely has sparked some interest in you. Is there anything you took from the report when you had a chance to read it?
So I completely agree with the comments made there by Simon and yourself, Phil, as well. In terms of the actual report, just to go back to the report itself, obviously, as Blacks, we're members of IMLA. So, yes, I've managed to read the report. From a solicitor's perspective, it's very interesting to read such documents because it gives us the background information and basically the understanding and the crux of how lenders create these particular products, how the products are created, the availability of them, and then obviously the complexities that I identified within the notice periods of these products. Because from our perspective, we take on that transaction for an individual, be it a buy-to-let client or a company purchase potentially, or a remortgage, at the tail end of the process. So the input that you would have as a broker and the input you would have as a lender would be at the outset. So from my perspective, I would take it on once you've gone through the period of selecting that particular product and the product's been made available. Now, predominantly, clients would come to us where they have actually secured that particular mortgage product in principle. Now, because of the times and the way that we're working at the moment, we get a lot of transactions that are starting with clients where they're still yet to secure a particular product. Or, in fact, the product that was secured initially is no longer available to them. Hence, they have to go back to the drawing board to see what their financial options are. So actually, in terms of solicitors, it does have a live impact on our transactions and how we are then to produce the report, produce the documentation, and obviously comply with lenders' requirements. Clients at the moment, and I can say, are continually changing products throughout transactions. And it is a common issue purely because there are such a whole raft of different products available, and the availability of these products are changing so quickly. So yes, the 24-hour notice period argument, I suppose, can be argued in favour of clients, in favour of the BDMs, in favour of the brokers, but also in favour of solicitors, because I would have then produced the work on the basis of that particular mortgage offer, complied with all the lender's requirements in looking at it, and then a couple of days further down the line, I'm then produced with another product, a completely different product. So from my perspective, it's sheer duplication of my work, albeit that it's a different product. So that's one aspect of it. And also the fact that if the notice period potentially is provided in advance, then obviously your client or the broker would then be able to assess their options early on, so that it's avoiding the sheer duplication of such. However, like I said to you, the report I did find to be really quite interesting because it does identify the complexities
Absolutely.
of providing that notice period. So it's provided me with quite a bit of enlightenment as to what happens in the background before I get the transaction and before I'm looking at that offer. Now, I do think communication is key, and that's one of the things that I think is a benefit of having such a report. The fact that the solicitors, the BDMs, the lenders, the brokers, and everybody that's involved in a transaction, we can enlighten each other with our potential processes as to how we get to the end product, because without each other, we wouldn't be able to service the clients. And that's what's key. So I am very appreciative of such reports that do provide me as a solicitor with that background information, because like I said, I can see what you've had to do previously in order for me to get it through. The impact obviously on the solicitors dealing with the transaction is that if a product has been pulled, it's been withdrawn, it can cause delays in transactions, resulting in further costs for clients, going back to the drawing board with actually looking for further products. In terms of clients that I am seeing on a daily basis, they do tend to be the buy-to-let investors or private landlords with large portfolios. Obviously, these products are then going to be as a result of managing a whole raft of portfolios. It's not going to be a remortgage of one individual property. So if the product is then changed, it has a significant impact on the client's affordability in terms of that product, and also the affordability and the financial viability
Absolutely.
of progressing with their actual buy-to-let portfolio. So in actual fact, whether or not there should be a 24-hour notice period is one argument, but the fact that it does impact solicitors in the way that we work is actually a live issue that we are dealing with on a day-to-day basis. In terms of the report, like I said, I'm appreciative of reading such material because it does help me to then process and understand what has happened in the beginning. But from my perspective, the key to this is communication in order to be able to manage the client's expectations.
Just quickly, Jay, just so I really just on that one point, I think the report itself, I've had accountant based backgrounds try to um, explain similar over the years working in society, and I think that's one of the best sort of reports I've seen in terms of layman's terms to a certain extent. It was really clear and really simple, and it really made sense. So really worth a read if you haven't read it.
Well, that's a hell of an endorsement. I have to agree with you, Simon. I have to admit, I'm not from the industry, as everyone I make out every time I'm on this podcast. I say I'm not from the industry, but it was very, very good to read. So we'll put the link to the document within the text of this podcast. So if you want to have a read yourselves, get on there, download it, and have a read. It's well worth a go. Okay, let's move on to our next story and a topic we discussed quite a lot, and I know this is in Perdip's arena as well, and that's stamp duty reform. Particular lenders calling for reform of stamp duty is about £2,784 on average for a home around the UK, £14,184 in London. We know what property prices in London are like, so it's not really surprising, but there's a lot of talk about reform and what's needed and how it's going to help the market. So let's just open this as a wider discussion about where stamp duty sits. It's quite an old legacy payment, if you like, that's been around for a very long time. But is it time to bring it back? We've got another story to follow on with this where we talk about incentivising stamp duty, as it were. But Phil, just for now, let's see, what do you think? Is it time for stamp duty reform?
It's such a difficult one because of, I think we all know the flaws with stamp duty. It's a really, really blunt instrument. It stops movement up and down the property ladder. Even particularly like when you get to situations like matrimonial separations, and that can be an issue for people there. But at the same time, it's treasury income that actually we need as well. So if we say, okay, let's, I'd like to say, let's just abolish it, but we probably, in fairness of balancing the books, we probably need to replace that with something else. So can we replace? I think the big question is, can we replace it with something that's fair? I think what I am clear about is what we definitely don't need is another stamp duty holiday like we had in 2021, because that created a bubble and inflation prices and a lot of lenders and law firms to probably lose a lot of hair and massive stress levels. But it didn't. I just don't think it helped the market. It just inflated prices, and so I'm most definitely not in favour of that. Now, I know, Jay, you sent in. There was a follow-up article about could stamp duty reform chime in with energy efficiency, and there's some really powerful arguments in that article, but it's doing it in a way that's not going to create bubbles and inflation. That's key. But I think it does. That article does ask some really interesting questions about, could there be stamp duty rebates for energy efficiency homes? But then it's all, how's that going to be administered? What's the cost of that administration going to be? But I do like the idea, and I think they should be seriously debated and considered.
So, Perdip, come on, this is your area of expertise. What's your opinion? Is it time for stamp duty reform? Is it abolish it, get rid, or just let's modernise it, let's do something new? What's your opinion on it?
Well, just looking at the history of stamp duty, really, I mean, and the property market in Europe, in the UK has the oldest stock in Europe, basically. And stamp duty obviously dates back to the 1600s. Some do say that it's a historical land tax now and that it should be reformed. That is the main argument currently out there. Now, it does depend on, I would say it depends on how we have evolved the stamp duty land tax and where we see it going in the future as to how we are going to deal with it currently. I do not agree with the stamp duty holidays, unfortunately, that we've obviously been processing for the past couple of years, just because of the pressure that it's put on the industry, especially property solicitors. By all means, it's had the similar effect on everybody else. But in terms of the actual rates for stamp duty, the actual land tax itself was introduced in the early 2000s. So, like I said, some people do say that it is historical. We have had the same rate from 1980s up until the end of 1990s, and then subsequently the stamp duty land tax was then brought in and new rates were increased. The increments have changed over the years, so that has given buy-to-let landlords and private investors a little bit of leeway in terms of the property prices. So the increments between the bands have changed. Some argue not so significantly enough for it to have a benefit. I do think that there has to be some sort of a review, whether it's a complete reform. That's a different topic. And obviously, we can't speak for the government because we don't work in the government, but we can say the impact that it is currently having on private buy-to-let landlords, and I can say, is quite detrimental to the way in which people are progressing with their property transactions. Yes, but albeit that you can have various different reliefs available depending on the way in which you're set up to be producing these particular transactions. But I do feel that the increments have changed, but potentially not enough. And I do feel that there is some room for manoeuvre there to make a change to those increments. They would benefit the property market not only because of the fact that increments have not changed in line with the way that the property market has changed over the years. We have had a substantial reform in the type of products and the type of property transactions that we are working through, the type of properties that are out there. But the increments, I don't feel, reflect the type of transactions that we are currently working with. Just touching on the article that had obviously been circulated, the Energy Efficiency Infrastructure Group in the UK, GBC's proposals, potentially. I do agree with the idea of having a proposal for a stamp duty reform that is actually linked to the energy efficiency levels of homes. I do see the benefit of it. And one of the reasons is obviously purely the fact that it would help the government fall in line with this net zero carbon emissions target that they have. However, it also falls in line with the new EPC requirements that are going to be in place in the years coming. Now, they are quite interesting because they talk about the EPC minimum rating currently, which will then be increased to the level C. So it will be taken up to levels or above. So it's a minimum level C or above by 2028. Now, if stamp duty is linked to an actual energy efficiency level or some form of an incentive, that would then enable or assist or potentially even motivate landlords to make those changes now so that they can then reap the benefit of obviously being compliant with the EPC ratings going up, and also then potentially having a rebate, if possible, to claim if potential changes are made to the properties within 2 years. So I do think it would fall in line with the actual proposals, and it will also assist private landlords to meet the new requirements, which I know is a concern with private landlords currently. And that is another topic to speak in relation of, but just to touch on it, it will help them to make their properties more energy efficient before the regulations actually come into force. So it will then assist in deflating any of the panic that potentially has been created in the media or may be created going forward. So I do think it's an interesting idea, although I do understand there are going to be cost effects. If we do associate the stamp duty with the energy performance relates. And obviously, how is it going to be monitored? How is it going to be produced? How is it going to be regulated? What are the costs involved? So it is quite a sizable topic to discuss. But in terms of it, I can see that it would fall in line with the government's proposals, and obviously for the new EPC rating to be put in mind. So I do think that it certainly has more benefits than not in producing such a thing.
Okay, so we're all kind of agreeing that this second story we're now going to talk about, we're linking stamp duty reform with EPCs. So if you improve your home, you get a discount on stamp duty. But then we've had this issue with green mortgages that these incentives are there to improve, but actually are they wanted by the borrower? Phil, sorry, no, Simon first, actually. Simon, what does the market look like with green? Are people paying attention now? Are we starting to see that uplift of people wanting to improve their homes?
We have seen certainly on the buy to let an increase in inquiries about renovation buy to lets. So you renovate the property. Ultimately, we lend against the initial value of the property. You renovate, you increase the APC rating or whatever, and then we release further payments down the line. But I mean, we don't have a product at the moment, but there's certainly inquiries coming through for that type of thing. Residential wise, we've seen a little bit of an uptick, Phil, would you say, in terms of the green proposition? Probably not that much, though.
Yeah. I mean, I think one of the barriers to green mortgages at the moment is regulation in terms of how advisors are directed to give advice hasn't really caught up with it yet as well. So like understandably, when an advisor has to give advice, they have to recommend the best terms that fit their circumstances, and that always tends to be rate, understandably. So we sort of need to, so unless your green product is the best rate for those circumstances, you're not going to get a lot of uptick on the product. So that's a flaw at the moment that probably needs to be looked at. But I think the good news is we are seeing some really good further advanced products out there for clients who want to improve the energy performance of their properties. And if lenders can start doing day one further advances, or even agreeing like a pot, from at purchase stage, then that might be more effective, possibly. But I think it's still in its infancy at the moment.
Yeah, and I think the other thing, talk about sort of personal opinions on the podcast. If you want to do the right thing for the the environment and the green agenda, but if you're talking about couple of £100 a month over a 5-year period, you're probably going to go with that a cheaper rate, rather, and that's where we are, unfortunately, or rightly or wrongly, that's where we sit. And I'd make the same call. I think, well, I definitely would.
Thank you, guys. Lots of food for thought in there. I think we could talk about that forever. So we're going to have to move on. It amazes me how quickly we revert everything back to green. Anyway, so moving on. We're going to move on to our next story. And this is one for Perdip. And actually, we're going to talk about your blog, Perdip, because I was doing some research on rental reform and the Renters Reform Bill. And I came across your blog. So I'll tell you what, it's your blog. I'm going to let you do the introduction to give us a little bit of insight into some of the things that are coming up in the Renters Reform Bill and what that means for landlords.
Sure. So the Renters Reform Bill, just to give you a bit of background, it's basically one of the government's attempts to make changes to properties and to ensure that tenants have a levelling playing field when it comes to the affordability and the fairness of how the private rental sector is being managed. So that's one of the reasons as to why they have introduced this, or why they're considering it. It's currently being considered by the Parliament, and the general effects, and probably there are various different terms within the Renters Reform Bill, and it will affect pretty much every AST up and down the country that you can imagine, other than the Welsh tenancies. However, the biggest point to note from the Renters Reform Bill is the fact that the bill will abolish the Section 21 notice, which potentially will then give greater security of tenure to the tenants, because landlords will then not be in a position to evict tenants that are no-fault tenants. So that's the biggest point to take from any of this that is being, I suppose, concentrated on. Potentially, it's a significant reform of a relationship between landlords and tenants. It could change the way in which tenants and landlords behave. It could change the way in which their tenancies are monitored. It could also change the way in which tenants are selected in order to take up occupation for an AST, because the landlords could have an increase in demanding guarantors to be provided in order for the tenancies to take place. So that's one of the things that is being a huge change in terms of how they are working currently. At the moment, in the private sector, landlords are not obliged to get guarantees from tenants. However, it may then ensure that landlords do look for more security in selecting particular tenants, because they will not feel as though they have then an easy get out clause that they could potentially use as Section 21. Now, the changes, significant changes other than that, are the fact that rent increases will only be allowed once per year during the life of that tenancy for that particular year. The Ombudsman will actually be given some enforcement powers to deal with disputes between landlords and tenants, which is a completely new ground that they're considering. Currently does not exist. The Ombudsman will also then be given power to issue compensation of up to £25,000 to landlords potentially if they deemed in favour of the tenants' arguments. So the regulatory powers are changing within the actual bill itself if it is passed. The decent home standard could also be extended to the private rental sector. So obviously, currently, it's not extended to the private rental sector, albeit that there are certain health and safety standards that are applicable, but it's not the government's decent home standard, which also means that that could make it a level playing field across private and the public sector. That's a big change. In terms of the tenants, they would have a greater security of tenure, because obviously, if they're not at fault, the landlord cannot just simply process a Section 21 notice and ask them to vacate under the requisite notice periods just because they want the tenant to vacate the property. Under the new grounds, they will have to follow specific mandatory grounds and be able to prove those mandatory grounds in order to be able to evict that particular tenant, albeit that Section 8, which I will touch upon in a moment, is still valid. Now, in terms of how this affects the landlords, there are certain landlords that feel currently, and from speaking to many of the clients that we deal with on a daily basis, that they do feel that potentially if they're unable to process a Section 21 service notice to be served upon a tenant to evict that tenant within the requisite period, that they feel that they're not going to be given any recourse. But in fairness to the actual bill itself, there are other, like I said, grounds under the grounds 8 ground mandatory grounds that will be introduced, which they can use in order to provide the requisite service to take occupation of the property. Now, in terms of the saleabilities of properties for landlords, landlords tend to, and this is what property trends suggest, that they tend to achieve a higher sale price for a vacant property rather than a tenanted property, purely because if the property is vacant, the landlord can go in and make the relevant improvements to the actual property to obviously bring it upscale in terms of the fixtures and the fittings within the property. That then also means they can sell the property at a higher price. Now, if current landlords feel that they will not be able to evict via the Section 21 notice, what we may see is a higher number of Section 21 evictions currently taking place before the actual bill is passed and does come into force, purely so that landlords can evict tenants, vacate the properties, improve the properties, and achieve a higher sell price. And that's one of the things that landlords are considering. The other thing that landlords are considering is the fact that if they do have a tenant that is not necessarily a problem tenant, but they're contemplating as to whether or not they want to vacate the property to sell it on, it may then give them that little nudge to actually serve that Section 21 notice, to actually have that property vacated. So again, it does depend on whether it's economical for the landlord or not currently as it stands, but it may result in further Section 21 notices being served until that bill has come into force. Now, on the flip side, in terms of the tenants, obviously it gives them that security that if they're not at fault, the landlord cannot simply serve that Section 21 notice to vacate them. And in terms of vacating and providing vacant possession for that particular property, under the Renters Reform Bill, Section 8 would give them the reasons as to why they would then be able to be vacated. So under Sections 8, the power of under the bill could actually mean an extension to the existing grounds that are available to landlords to gain possession. And this is the change for Section 8. Landlords may be able to sell their property. They may be able to move into the rental property itself. They may be able to regain possession from antisocial tenants or tenants that are in arrears. However, they would have to comply with one of the mandatory grounds within Section 8 to be able to do that. So although landlords currently are saying we are losing a Section 21 route in able to evict tenants, what the bill is proposing to do is actually provide the landlords with set mandatory reasons as to serving a Section 8 notice in order to evict the tenant. So instead of having a general Section 21, what the bill is considering is specific reasons which must be met in order for a Section 8 to then be noticed, served upon the tenant. In terms of the changes of the Section 8, for example, selling a property, that's going to be obviously a new power for a landlord to be able to do. Serving a Section 8 to say that they want to be able to sell the property. They can't use that particular ground for the first 6 months of the AST, so for the tenancy, but they can give 2 months' notice in order to sell. So that is a new ground that will be available to landlords in order to use. So it should give a little bit of comfort that they will still be able to enable the vacation of that property under the Section 8. In terms of antisocial behaviour, the current notice period is 2 weeks, which is going to remain the same. It will be 2 weeks. In terms of a tenant that is in rental arrears, there will be a new mandatory ground of a notice period of 4 weeks as opposed to 2 weeks. Now, with the changes, all of the evictions will have to be based on an approved reason that's been provided by the landlord through the Section 8 notice. And that is the comfort that is given to the landlord, that the reasons have been expanded or are looking to be expanded. So it does mean that you could use one of those reasons. The landlord does need to provide some evidence, obviously, that this has occurred, just to ensure that once that Section 8 notice has been served, and as long as the landlord has that evidence to back up the actual notice itself, then they can then progress to a court order, potentially, if the tenant fails to vacate. So really, the actual bill itself, it looks like it's providing more of a clear and concise process, and it's more detailed in terms of the grounds that potentially could be available to the landlord, as well as providing the tenant with the protection that if they are not at fault, then the landlord cannot just simply merely serve that particular notice and ask them to evict. Obviously, it is the fear of unknown with landlords and tenants and how it's going to be viewed. So in practice, if the bill is passed, it does depend on as to how successful the applications to court are going to be in obviously evicting. If a tenant does refuse to vacate after a 4-week notice period, potentially for rental arrears, then yes, of course, the recourse for a landlord is to then go to court to get the application to vacate. So in effect, yes, it does mean that they're going to be further. I would assume it would be more court applications. Potentially, it could reduce the time, in effect, of actually getting from the start of a process to the end of a process, purely because the grounds are going to be expanded. But obviously, time will tell. Are landlords getting more control over the way that they would deal with such situations? The indications point towards the answer being yes, they are getting a little bit more control, purely because, like I said, the grounds are going to be extended and there'll be mandatory grounds. But in terms of the way in which tenants have been treated in the past, this is, like I said, the way that landlords and tenants are going to be brought up to the same level. So although it may provide more protection for tenants in the landlord's eyes, it's also then going to provide a clear and concise process for a landlord to then proceed down the route of, in the event that they would need to take the particular action to get their property back to sell onwards. So yes, it is a fear of unknown, but I think it's one of those situations where, let's see, time will tell as to how the actual bill itself pans out.
I don't know what to say. That was absolutely brilliant. Talk about a snapshot of the whole thing. Thanks so much, Paddy. That was absolutely brilliant. But I suppose what we've got to look at here is more regulation, more hoops, more jumps for landlords. Is that putting people off? Simon, you work with brokers directly on buy-to-let products. Have you seen any downturn, upturn, any changes, anything that you think, well, actually the market's starting to change?
It's a real mixed bag, to be honest with you. There's brokers coming to me and my clients are selling their portfolio. They don't want to do it anymore. And there's others that are buying more. So it is a real mixed bag in terms of what we're seeing. We're still seeing buy-to-let applications come through, particularly on the expat. Plenty of expat applications coming in. Yeah, definitely. Probably maybe better than expected, I suppose, with the sort of recent changes and how tough it's been for landlords. But yeah, we've had a strong year for expat buy-to-let so far.
Good old expat buy-to-let, always good. Nice to know the market's enticing still. So Phil, coming in, your snapshot. How's the industry looking? What do you think it looks like right now?
I can only speak for us. We do more. We're seeing an uptick in limited company buy-to-lets than held in individual names now. I mean the views, the vibes that I get from our intermediary partners is that we're perhaps seeing some landlords, some more professional landlords changing their portfolios as well. So they might be selling some of their stock, but then replacing it with other stock. So some more new build properties they've been buying. We've seen a few areas of that. I think that was mentioned on our last podcast as well. So yeah, whether some of them looking to offload some of their, inefficient stock that they don't want to upgrade. But yeah, it certainly hasn't killed it, and I think with the continued business levels we're seeing for expat is telling me that folks still think UK property is still a good efficient use of using your capital for capital appreciation.
Just in terms of the buy-to-let property market, so the demand for buy-to-let properties is considerably high. Many people do actually choose to rent property as opposed to the fact that they want to buy their own property. So it's not just the fact that landlords are investing to invest and build their own portfolios. There really is a genuine demand there out there for people and tenants who want to just rent property. So it's not just the argument that they must rent because mortgage affordability is an issue currently. And also the diverse variety of properties out there is becoming ever more popular than before. Hence, the demand for lenders to produce competitive products. Yes, if swap rates do reduce, obviously lenders can relay that to the individuals via their products. So if borrowing less means that better products are then produced by particular lenders, then of course that's just going to strengthen the market. There is an increase in property transactions. We do have a buoyant market, yet it is competitive, and that's exactly what we need to strive for in the future.
We do actually have another story related to this on buy-to-let, and that's just this is only one story that I've seen, but there's several of them, that lenders are starting to drop the rates for buy-to-let mortgages, so they're trying to encourage the buy-to-let lenders in. So it seems to me like they want to keep that sector of the market buoyant, and as Perdip just said, the interest is there. So we're going to talk about swap rates a bit later, but if we get time. But Phil, the story's all about dropping rates. Are we starting to see? Is this it? Are we starting to see the light at the end of the tunnel? Are we going to start seeing rates going down? We've had good inflation news. What's next? Are we going to have some joy at long last?
I think it's too early to tell. I think we need to wait and see. We had some very positive news that inflation was better than what we thought it was going to be. So they were expecting it to be slightly higher, and so the figures were better. So that seems to have calmed the markets down, who are pricing who are pricing the swap rates between lenders. So that's a good positive indicator. In terms of rates, this is just purely my call. I probably surmise that I was expecting the Bank of England, before the inflation figures were announced, to the next one, to put another 0.5% increase on the base rate. I think it will now be 0.25%. So I still think the Bank of England rate will still go up, but possibly not quite as high as they intended. That's what I think is the best case scenario. What my personal view is, I would like them to leave rates alone and just let things settle and play out, because we've made this point before, is that the majority of lending now is on fixed rates, and we are still seeing those fixed rates maturing, and all the previous increases are still working through the system. So let's wait and see, and let's hope we have some more good news on inflation as well. I think that's another worry, is that, if we say, for example, I know Russia has stopped their grain deal with Ukraine. So if we see the price of grain increasing, will we start to see food prices increasing and inflation going up again? I don't know. That's big. There's a lot of big factors in play that could change things. So let's hope for the best, and let's hope things are just calming down a bit, and we can all adjust to the new norm.
One thing we find it incredibly hard to adjust to is the amount of time we have on a podcast, because I'm afraid, guys, we're going to have to cut it short. The swap rate story will have to wait. Maybe put it into the next podcast, but that's it. We have run out of time. Before I thank I thank the two boys first. Phil, Simon, thank you as always. It's really lovely to have you with us. And Simon, we will bring you back. It won't be another 6 months before you come back to us, I promise. But I want to share a big, massive thank you to Perdip. I've learned so much on this podcast. I've had so much fun listening to you. So from all of us, I'm sure, a massive, massive thank you. And I hope you'll join us again and join us on the webinars too.
You are welcome. And thank you for inviting me on, honestly. I have to say, I just love the fact that between the three different various backgrounds that we all come from, and four, sorry, Jay, including yourself, the fact that we can actually have a conversation about this, because we don't talk enough between each other, and that's a problem.
It really is, and that has been a hot topic on a lot of our podcasts. So thank you again. And just a reminder, those podcasts are available wherever you listen to this podcast, whether that's Spotify, whether that's Google Podcasts, Apple Podcasts, wherever you get your podcasts. Do have a look back. We've got green specials. We just went constantly about EPCs. We've done loads of buy-to-let specials. There's lots to choose from. We're back again in September, where hopefully Tony will be back with us as well. And our webinars, live webinars, which are now now LinkedIn Lives, so SFI Live, they come back also in September. So we'll release on LinkedIn the topic for that in due course. A big thank you again to the panel, and that's it from me, Jay Evans, your host for today, for this August podcast, and we will see you again in September. Goodbye.